Welcome to TalkTickers. We're doing our deep dive into company earnings calls, focusing today on Trinity Industries and their Q1 2025 results.
That's right. And the headline numbers were GAAP earnings per share at 0.29 cents, with revenues hitting $585 million.
Okay, 0.29 EPS. But what really caught my eye was the context around that number.
Exactly, because that $1.29 EPS, well, it's a 12% dip year over year. But here's the thing. External railcar deliveries were down a lot more, like 38%.
38% fewer cars, but only a 12% hit to EPS. That's interesting how they managed that.
Well, the adjusted return on equity for the last 12 months was still pretty solid at 14.2%.
Right.
And it really points towards the strength in their other business segments, particularly leasing.
Right. The leasing side seems to be the buffer here.
Definitely. Fleet utilization stayed really high, 96.8%. And that future lease rate differential, the FLRD, it's sitting at a healthy 17.9%.
So leasing is providing stability.
It is. But they did flag, the market uncertainty. It's making customers hesitant, slowing down the conversion of inquiries into actual solid orders for new rail cars.
Okay, let's dig into that leasing and services segment a bit more then. How did that specifically perform?
Well, revenue there was actually flat compared to last year.
Flat, even with strong rates.
Yeah, because while they got those higher lease rates, which is great, it was offset by lower volumes for external repairs. And they mentioned some weather impacts on maintenance schedules, too.
Got it. But the rates themselves?
Oh, the rates were impressive. Renewal lease rates jumped 29.5% over the rates that were expiring.
Oh, nearly 30%.
Yeah, and they renewed about 75% of those leases coming up. That's a strong success rate.
That kind of pricing power is significant, isn't it? What's driving that big increase?
It really points to how tight the overall rail car market is right now. Fewer new cars being built industry-wide means existing cars are more valuable.
So lessees are willing to pay up to keep the equipment they have. Makes sense.
Exactly. And that pricing power, plus they had about $6 million in gains from selling off parts of the lease portfolio, about $34 million in sales that helped boost the operating margin in leasing.
Okay.
They also put $87 million into the net lease fleet this quarter, which keeps them aligned with their full year guidance. It really shows how those hard assets, the rail cars themselves, offer stable returns, especially now.
Right, a reliable anchor.
Sure.
Now, let's pivot to the Rail Products Group manufacturing and parts. Yeah. That's where we saw the delivery dip.
Correct. They delivered 3,600 new rail cars, but orders came in for only 695.
Oof. That's quite a gap.
Yeah.
Really highlights those delayed decisions you mentioned.
It does. And the direct result obviously was lower revenue for that group. Operating margin was 6.2%.
6.2%. How does that compare?
Well, it's down sequentially and down year over year. And that number also includes some costs from workforce rationalization they had to do.
Understood. But they still have a backlog, right?
Yeah.
I think it was around $1.9 billion.
It is $1.9 billion. So that provides some visibility. And they did say order activity picked up a bit moving into Q2.
Okay. A little green shoot, perhaps?
Maybe. But they did revise down the full year industry delivery forecast, now expecting somewhere between 28,000 and 33,000 cars for North America.
So caution still prevails across the board.
Seems so. They also mention, interestingly, that while current policy proposals aren't causing major direct cost issues for them, they are seeing an impact on just overall demand and revenue in manufacturing.
And didn't they mention something about the overall fleet size?
Yes. A notable point, the total North American railcar fleet actually contracted in Q1, first time in about 2 years that's happened.
So fewer cars overall in service.
Yeah, we have.
Okay. Given all that, how are the overall financials looking? Cash flow, balance sheet?
Pretty solid, actually. Cash from continuing operations was $78 million in the quarter.
Okay.
They returned $33 million to shareholders. $25 million of that was dividends, $8 million in share buybacks.
Good shareholder returns.
Yeah.
Liquidity.
Strong. About $920 million available between cash, their revolver, and warehouse availability. And the loan to value on their wholly owned fleet is 66.2%, right in their target zone.
Okay. Financials seem stable despite the manufacturing headwinds.
Yeah.
What about the outlook for the rest of 2025? You mentioned the revised industry forecast.
Yeah, so building on that, they expect Q2 to be the trough, the low point for production, deliveries, and probably earnings too.
So expecting things to improve in the back half of the year.
That's the projection. They're assuming some of those inquiries do convert to orders. For the full year, they see the rail products operating margin landing between 5% and 6%.
Reflecting those lower volumes and maybe some margin pressure.
Exactly. But capital expenditure plans are unchanged. They did refine the full-year EPS guidance, though, narrowed it to $1.40 to $1.60 per share.
$1.40 to $1.60 EPS for the year.
Correct. And they kept emphasizing the leasing fleet, strong performance, strong cash flow expected there, thanks to high utilization and those good lease rates. Management sounded, confident in the long-term fundamentals.
Believing the platform can still generate significant cash and returns over time.
That was the message.
Did anything particularly interesting come out of the Q&A session with analysts? Any clarifications?
Yeah, a few good points. They clarified the lease rate numbers, that big 29.5% renewal increase. That reflects this quarter's specific renewals.
Okay.
Whereas the 17.9% FLRD, that's forward-looking. It's the weighted average impact over the next 4 quarters, and it depends on the mix of cars coming up for renewal.
Got it. So different time frames, different calculations.
Right. They also expect leasing revenue and margins to keep improving with renewals and fleet growth, but gains on selling cars more weighted towards the second half of the year.
Like manufacturing in Q2.
Confirmed a lower deliveries expected. On pricing for new cars, they think it'll stay relatively high because input costs are still up.
But maybe some margin compression?
Yeah, they acknowledge that. More competition when volumes are lower tends to squeeze margins a bit.
Makes sense. What about those inquiries they mentioned? Any color there?
They said inquiry levels are high, which is good, and some large orders are apparently close to being finalized, especially for tank cars, maybe less so for freight cars right now.
Interesting focus on tank cars.
But they don't see orders really outpacing deliveries until maybe 2026.
So still a ways off for a full manufacturing rebound.
Potentially. But the tight overall fleet does continue to support that strong leasing business, which is key.
What about deliveries to their own internal fleet?
About 29% in Q1, and they expect it to be over 30% for the full year. So they're still feeding their own leasing business significantly.
Okay. And share buybacks.
Will continue, but opportunistically. No set schedule.
And any financing updates?
Yes, they just closed a new $1.1 billion bank term loan. It's mainly to refinance existing debt and upsize their facilities. They felt the spreads were pretty attractive.
As a sign.
And they mentioned the ABS market, asset-backed securities, is still a good option for them for future financing too.
Okay, thanks for breaking down that Q&A. So if we step back and try to summarize the key message for investors looking at Trinity right now.
I'd say it's a story of 2 parts. You've got a cyclical slowdown hitting the manufacturing side, no doubt about it, driven by customer hesitation.
Right.
But that's being significantly cushioned, maybe even offset, by the really consistent strength and profitability of the leasing business. Those high lease rates and utilization are providing a strong foundation.
So the near term really hinges on converting those manufacturing inquiries.
That seems to be the key variable for the second half of the year improvement they're hoping for. It all comes down to turning those conversations into contracts.
All right, now let's shift gears to our favorite segment. This is not financial advice. Time for an outrageous but plausible trade idea. What have you got for us today?
Okay, here's one to chew on. Given that Trinity's leasing is strong but new orders are slow, how about this? Go long Trinity Industries, but pair it with a short position on a company that focuses on, say, railcar dismantling and scrap processing.
Long Trinity, short a scrapper. Explain the thinking there.
Well, the idea is if that rebound in new car orders takes longer than expected, what happens? You might see more older cars getting retired and scrapped.
So the dismantling company benefits from higher scrap volume.
Exactly. While your long Trinity position is hopefully buoyed by those steady leasing revenues, even if manufacturing stays weak for a bit longer, it's a play on a potentially delayed new build recovery and maybe an uptick in retirements.
Interesting hedge against the manufacturing uncertainty.
Okay.
Definitely outrageous, but plausible. Do you have another one?
How about this, a slightly different angle? Focus on the strength of the leasing market, those high renewal rates, high utilization.
Right.
Consider a long position, perhaps, in a REIT, a real estate investment trust that specializes in industrial assets, particularly warehousing and logistics facilities.
Connecting rail leasing to industrial REITs.
It's a second-order effect play. The argument is that strong, steady demand for rail transport, reflected in Trinity's leasing success, will indirectly support demand for the warehouses and logistics hubs that connect to that rail network.
So betting that the fundamental health of rail spills over into the broader logistics real estate sector.
Precisely. Capitalizing on the underlying strength shown in the railcar leasing market, potentially benefiting adjacent industries.
Another thought-provoking, non-obvious connection. Okay, great stuff. That wraps up our deep dive into the Trinity Industries Q1 2025 earnings call.
We've unpacked the results, looked at the segments, and considered the outlook.
And remember, everyone listening, this analysis is purely for informational purposes. It is absolutely not financial advice. Please always conduct your own thorough research and due diligence.
So what are your takeaways on Trinity's path forward? Any other earnings calls catching your attention? We'd genuinely like to hear your perspectives.